Ottawa homeowners, your mortgage renewal in 2026 is not the disaster people are predicting, but it will change how much equity you are building in your property currently. It feels like yesterday people were bragging about, having their 1.8% interest rate or 1%, whatever the case is, and those homeowners are calling me asking me, "Dean, am I in trouble now?" If that's you, don't panic. The mortgage renewal cliff is real. Today I'm breaking it down in a simple, Ottawa-focused way so you know what to expect in 2026 for your mortgage renewal. So to start with some context, the renewal cliff, what it actually is. In 2021 and early 2022, a lot of homeowners locked in their mortgages with, 1.5% to 2.5% fixed rates. And those renewals are coming up between 2026 and 2027. The original fear was your payment will double, I'll be forced to sell, and huge spike in Ottawa inventory. Now, here's the reality. Here's the reality though. Payments will rise, but the bigger issue is actually the amount you're paying down on your property as opposed to how much your payment will spike. Looking at the Ottawa market, home values are still slightly below the 2022 peak, especially in areas like Barrhaven, Canada, Orleans, Stittsville, and Riverside South. Buyers from those peak years in 2021 and 22 may be at break-even points or slightly underwater or even slightly making a tiny profit depending on which area they bought in and what that area is doing currently. This all matters less if you're staying long-term. So if you're looking at 10 years, none of this will matter today. In 7 to 6 years, it might make a difference, but you're probably going to be in a better position because overall the market does continuously slowly rise, right? But let's take a look at why this still matters. Low rates meant that most of your payments went to principal instead of interest. Now, renewing at 3.5% to 4% flips that ratio. So that means more is going towards interest and less towards the principal, which overall means that less is going off to pay off your total mortgage. Your monthly payment increase might be manageable, but what happens is your equity growth is much slower by a significant margin. So here's a real Ottawa example. Let's take a look at scenario one. So you bought a home at 900 to a million in 2021 in Orleans or Canada or Barrhaven. You put 20% down, so that means you had a mortgage between 720 to 800K. The rate was 2%, payment roughly $3,300 to $3,500. 5-year principal paid $150,000 to $177,000. Very little interest paid, strong equity building. Now, if you're renewing in 2026 at 3.8%, give or take, let's say, new payment is $3,750 to maybe $3,900, right? The increase is between $350 to $450. Not catastrophic, but interest doubles, slower equity build, right? The real impact no one talks about is payment shock isn't the bigger issue anymore. The equity slowdown is. At 2%, 75 to 80% of the payment hit principal. At 3.8%, it's closer to 50-50. Long-term wealth in your home becomes slower. Now, the real question is, will this force Ottawa sellers into the market? Most cases I'm seeing with local clients is that payments are manageable, but there is frustration building. Biggest reason people are selling is either rate increases, they're frustrated with them, or home didn't appreciate since 2021 and maybe they're breaking even, or they're either relocating, downsizing, upsizing, or they want to reduce their monthly costs. Not a forced selling situation, but more of a lifestyle change, which means they aren't actually forced to sell. They don't need to sell. They would like to sell and want to take advantage of what's available in front of them. So it's not Ottawa is a very different market where it's very, very stable. And yes, we are seeing some job losses. The economy is in a weird place, but it's been one of the most stable markets for a long, long time. And what we're seeing is a lot of lifestyle changes, but not a lot of forced sellers being, pushed into the market. Whereas some other cities like Toronto and Vancouver, you're seeing a lot more of that where somebody is forced to sell. They're not in control of what they can get. Their bank is telling them, okay, well, you have this many months left to sell, or we're repossessing, or whatever the case is. Now the question is, who should be paying attention to these stats? Anyone who bought in the suburbs in 2021, you should be paying close attention to what's happening in your area, but also seeing what your options are for renewal. Now, if you're on a very, very low rate and you're set for that until 2026, please start calculating now, what is it going to cost you to be in that same home, but also what's available for you in a new home, maybe a different home, maybe a different location, and see what the math works out as, because maybe you could change your lifestyle for the better and still be at a similar payment without having to sacrifice too much. The other type of buyers that are paying attention to this stuff is the new build buyers. So people that have bought new construction homes pre-con and they're looking to be, closing between 2025 and 2027. This is going to be very, very interesting for them because if they don't have their rates locked in, they should be. But also too, like if you bought a pre-con last year, the rates were much higher last year than they are this year. So you could still get, typically with most banks, you can get an 18-month closing with a locked-in rate, which is great, right? So like if rates are really good right now, last year we were probably looking at 4.5%, 4.2, 4.7, somewhere in that range. Whereas now you're looking probably, depending on your qualifications, depending on which route you're taking, you could be anywhere between 3.5 to 4. So there could be some savings there, and then depending on what price you paid. But honestly, I always say like for pre-con buyers, you want to make sure you have things locked in. So as a worst case scenario, this is going to be my rate, and this is what I paid for the home. As a best case scenario, maybe the rates have gone down, and you can lock into one of those rates instead and go forward from there. The other part that we talk about is investors. These people are going to be paying close attention because most of them are maybe either on variable or high loan to value mortgages. So that's something that investors need to keep an eye on. Here are some things you should be doing before renewal. So start planning early. I always recommend 6 to 12 months in advance of your renewal period. Go out there, do some shopping, get some rates. If you need help with getting a mortgage broker or a mortgage specialist at a certain branch, reach out to us. We have great connections with a lot of really good mortgage specialists, and we can get you those aggressive rates. One thing a lot of people don't talk about is your exploring options. So re-amortizing, maybe if you were on a 25-year amortization, maybe for the next 5 years, if you plan to stay there long-term, maybe try re-amortizing at 30 years, right? Take a look at a few different options and what's available to you before you're kind of forced to sell. But again, like there is a lot of options as long as you start ahead of time, right? If you're doing this a month before renewal, you're kind of between a rock and a hard place. I always say between 6 months to a year. Typically a year out is usually a good time period because you don't know what options are going to be out there, and being in touch with a mortgage specialist or a mortgage broker is going to help you in the long run while you're preparing for that new renewal. Oftentimes we even say, maybe consider switching lenders. Maybe some lenders want to buy your business, right? A lot of people they just go with their bank that they bank with. And I always say, why not shop around? It doesn't cost you anything to shop around. It's all going to a bank. It doesn't have to be, if you're with CIBC, great. But what if RBC is giving you a way better rate with more favorable terms? What if RFA or RMA mortgages is giving you a much better rate than what you were looking at, right? Like I remember buying my first home. I was with TD. I wasn't in the real estate industry, and what I did was I was like, okay, well, what is TD going to give me? They gave me a rate of, at the time it was 2.9 or 3.2, whatever. And then I talked to a mortgage broker, and I got 0.75 less with going with a random bank, and it was like a life insurance bank, right? It was, anyways, I forget the name, but I didn't even know they did mortgages. But I said, you know what? That's a savings of $150 a month. I'll take that. I'm not tied. I'm not married to TD Bank. So these are all things that it just requires a little bit of exploring. It does take a little bit of time, but ultimately it's your lifestyle that's being affected. So spending a bit of time on that to have a really good lifestyle could be the difference. Another option is selling and repositioning, right? So maybe if you have built some equity, or if you're looking to upgrade to a home, and check to see what does it cost to upgrade, or what does it cost to downgrade or relocate? What is your average price point going to be if you sell over the next 6 months and then reposition into a different home? Or, there's a lot of people that moved out to the suburbs or moved out further out from the city that need to be back in the city now. So look at, what is it going to cost me to move back into the city? Am I in a better position? Is the market different there? What's the market I'm in currently? And just looking at all those options. The other option is, if you do have some cash money and some cash down to buy another home, you can turn the current home into a rental property, rent it out, become a landlord. There is some things you need to watch out with that, but it's a way to keep the asset and still purchase a new home. The biggest thing is, if you're looking at renewing in the next year, I would still consider saying, hey, what does a market evaluation look like on my home? What are my rates options? What's my renewal option, and where can I go from here? So having all the cards on the table and seeing where you can go from there. If your renewal is coming up and you bought in 2021 or 2022, or if you bought even before that, Feel free to reach out to me. I can give you a brand new renewal report on what to expect, especially with payments, and I can get you connected with a mortgage broker that will help you out and suit your needs. And then as well, we can also get you a free marketing report free market evaluation on your current home. And you can book a call with the link below. Thank you for watching, and if you want more tips and tricks on buying or selling in the Ottawa area, feel free to like, subscribe, and follow for more. I'll see you guys in the next video. Have a great day.